Hi, this is Tron Welch with Welch Financial Planning, and welcome to our fourth quarter 2024 investment update. We're going to go through about 10-15 slides here, kind of catch you up with what's going on in the market, and away we go. So let's start with the returns overview. This is the familiar quilt chart, which we review regularly. The year-to-date stock market has performed impressively as well, and then a well-diversified portfolio, which is the white box there, has returned about 12.3% for the year to date. So if your portfolio is a little bit more on the aggressive side, you should be above that. And if your portfolio is a little bit more conservative, you're probably below that. So from here, if we look at the S&P valuation measures, the one that we really focus on a lot is the PE ratio. And from here, you can see on the far right-hand side of the chart that current PEs are at 21.5%, which is way above or significantly above the 30-year average. So when this happens, there's two things that we can see that will occur that will kind of move it back towards its average, and you can see over time it crosses back over that several times. So one is the good news is that future earnings will grow faster and then justify the PE, or the other is that the stock market will decline and bring the PE ratios into balance at that point. So the future will unfold and we will see what happens. But one of the things that I really want to talk about is the index concentration that's going on. And if you really look at the upper right-hand corner, you'll see that the weight of the top 10 stocks in the S&P 500 now constitutes 35%, or basically 1/3 of the S&P 500 is down to 10 stocks. And that is really something that we got to think about. We haven't seen that before, obviously. And what does it mean? And do we need to do anything about it? But it's certainly the S&P 500. The purpose of it is to diversify your portfolio. And really what's happening is that you're concentrating on 10 stocks. But it's a little bit more than that. There's a term that you probably have heard called the Magnificent Seven. And actually the concentration is this group of seven. And this is Meta, which is Facebook mostly, and then Microsoft, Nvidia, Apple, Tesla, Amazon, Alphabet, probably the companies that you would guess. But these 7 companies are absolutely gigantic, and they are driving the market. And the struggle is that if you want to stay up with the market, and if you want to return similar to the market, you're going to have to invest a lot of your portfolio into these single 7 stocks, which then is kind of offsetting one of the golden rules of building wealth over time, of being diversified. So the challenge is trying to get into these companies, writing them up, but knowing when to step off should they decline. So here you see the performance of the Magnificent Seven stocks in the S&P 500 on the left-hand side. And you can see that in 2023, the Magnificent Seven is worth 45% of the gains in the stock market for the year. And so 7 stocks are accounting for 45%, which means that 493 stocks are responsible for the other 55%. So it's absolutely just, it is a big tail wagging the dog. But on the right-hand side, down at the bottom, you see profit margins. And you do see that the Magnificent Seven profit margins really have been increasing, while the other non-Magnificent Seven, or the other 493 stocks, really their margins have been, kind of really not that exciting and moving sideways for the most part. So the only sector of the stock market that is really growing is these 7 companies. Obviously, there's a few exceptions in there, but when you look at it in general terms, it is the Mag 7 that is increasing their profits and increasing their stock price. So one of the things that happens, I usually get a couple phone calls when the market hits all-time highs with people kind of concerned about it. And it makes sense to me that, as the stock market climbs up, people get a little bit uncomfortable. This is a chart that I saw for the first time just a couple days ago, and I thought it was interesting. So the left-hand side will show you that clearly we are at an all-time high. And on the right-hand side, it kind of looks at if you invest your money on the day of a new all-time high versus investing on any other day. And so you can kind of see that actually investing at the all-time high or the day of the all-time high, you actually perform better when you get out, the 1 year, 2 year, 3 year, and 5 year. And that's why we invest in the stock market. Please don't invest in the stock market for the next 3 to 6 months. We only use the stock market for long-term investing. And so the other thing that I would say let's just look at the 5 year mark. So investing on any day, you got 73.8%. And investing on the all-new high, you got 79.6. I think the actual takeaway is that it's the driver, that your returns are driven by the days in the market. And the longer you're in, the better the returns get. And so I would encourage you, if you've got cash on the sidelines, or you're kind of wringing your hands, that we go ahead and move forward, get you in the market, so 5 years from now, you're glad that you took action today. One of the things that we really look at is the international valuations and dividend yields, okay? And in this, I want to look at the left-hand side, which is the price per earnings discount to the U.S. And we can see that international stocks are trading significantly cheap relative to the U.S. And I've been getting emails about this for probably about 5 years now, kind of jumping up and down about the opportunities in the international space. And year after year after year, it just doesn't happen. And so we kind of call this, it's not a great term, but it kind of works, is that we call this a sucker chart, to where you just kind of look at the surface of it, and it seems like, well, it's obvious we should be overweighting international because we're not properly valuing it. And I think that's true until you kind of look down into the data. And when you see the makeup of international stocks versus the US stocks, I think it answers the question. So looking at this, our domestic market, the S&P 500, 33% of that index is technology, while international, only about 8% is technology. And so really, it does make sense, because technology, not to state the obvious, but technology is the future growth and has been the growth area for a couple decades, and I would assume be the growth area for the next couple decades. I don't think Procter & Gamble is going to create a new shampoo that is going to increase sales by 300% in the next year. So 2 points here. One, the United States is the center of the world when it comes to technology. There's certainly other countries that are getting ramped up. Certainly China is making great gains on the technology scale. But the U.S. is clearly the leader of the world when it comes to technology. And so it doesn't really surprise me that our stock market is valued significantly higher than the international stock market, because we really own the large tech firms and opportunities moving forward. So we are not overweighting international, and I believe technically we're slightly underweighted international, and we're comfortable with that decision, and I don't believe that we'll regret it moving forward. So with that, I do want to make a couple other comments. We did move into China about 18 months ago with a fairly, what I considered a fairly material portfolio. And China basically moved sideways for the last 18 months. And then the Chinese government did announce some stimulus package, which jumped the Chinese market by about 25 to 30%, and that is reflected in our holdings of China. We do believe that they're getting pretty close to fair market value, and so we'll probably be exiting those in the next month or so. So with that, I'm going to go ahead and wrap it up. If you have any questions or concerns, feel free to call in. Always happy to talk to you. Investments are fun, and look forward to seeing you soon. Take care. Bye-bye.